Okay, it's October 30th, so let me first wish everybody a happy and safe Halloween for those who celebrate. Hey, folks, welcome back to Macro Crazy, where we help you on your macro trading journey. If I sound especially bad tonight, the reason is simple. I did an ultra marathon, 50 miles yesterday, so just bear with me and my crappy voice tonight. Okay, like usual, I won't bury the lead. Obviously, you saw the thumbnail, and Morgan Stanley is in the image that's up right now. Uh, Chief of, I think, U.S. equity strategy is out with some comments that was posted on Zero Hedge over the weekend. Going to give you the bullet points real quick. So this guy is basically admitting that the call from a couple weeks ago, apparently they made a call about buying stocks, and it was a purely technical call back then. And I think I did mention on Thursday, about 10 days ago, that there was a reversal signal. Market was down big and ended up big near the highs. So that was a reversal signal to me. Morgan Stanley is basically saying the same thing. And but now they're adding in some fundamental color for their buying stocks call from a couple weeks ago. They're saying CPI is coming down, and it's coming down quite significantly. M2 is falling fast, and in the near future, it could fall below zero. So continuing, Morgan Stanley is saying that we're close to the end of rate hikes. Investors are always forward looking, so they're already anticipating that. And as far as earnings go, they're weak, but not weak enough. And they think that estimates have to come down quite significantly, along with margins, which are going to drive those lower estimates. Okay, so what does that mean as an investor? Well, basically what they're saying is in the short run, they're looking at 4,000 to 4,150 on the S&P, so it's still risk on for right now. But after that, it's going to be a risk off trade, and it could be multiple versions of that depending on earnings estimates going forward. Okay, looking forward to the week. Monday, we have Chicago PMI. It's kind of a significant number. We'll see, but I don't expect any shock and to take away from the trend, which is up. Tuesday, manufacturing PMI, but it's a final number, so I don't expect anything exciting there. ISM could be interesting. Job openings and quits, mildly interesting, not huge. Construction spending, home building probably might have an impact, but not a huge number, I don't think, right now. And motor vehicle sales will be out there. The supply chain issues have been an issue. We'll have to see if that's continuing. But nothing too terrible, too big in the first 2 days. Finally, on Wednesday, we have ADP employment, which is always of interest to some degree, at least. Indications of how the employment market is holding up under duress. Rental vacancy rate, not a big number. I wouldn't obsess about it. Although, if you own or are interested, in any of the apartment managers or companies that are renting out tons of homes, might be of interest to you. And the moment that everyone will be waiting for all week is the FOMC announcement, looking for 75 basis points and future direction. Any indication that a pivot is in the offing will set this market alight, and it will just take off from there. Okay, to summarize, so this week it's all about risk-on positions per Morgan Stanley, 4,000 plus, 4,100, 4,150, whatever you want to look at or define as your point. It's the S&P 500. You can reduce risk with diversified suppliers. Lastly, and the biggest, is to look for direction from the FOMC. Like I said before, any hint that the pivot is here or close by is going to send this market up like a rocket. Good luck this week.